Welcome to the show. I'm Andy Hagans, and today we're talking about the alternative property sectors that might be driving the best returns in the future. Joining me today is Keith Lampi, CEO of Inland Private Capital Corporation. Keith, welcome back to the program.
Thanks for having me. Great to be here.
And, on this show, we talk about all kinds of sectors, and I want to be clear, I love multifamily, I love industrial. I'll never really get tired or sick of talking about those. They are favorites amongst LPs and family offices for a reason. But we want to dig into some of these more niche property sectors that historically maybe have been a little bit more resilient during economic downturns that may be poised to outperform in the future. But Keith, before we dive into that, before we dive into Inland's thesis, could you give us a little bit of background on Inland for any of our viewers who missed the previous episode?
Absolutely. And to your point, Andy, I mean, we love many of those sectors too. And, multifamily in particular has been kind of a mainstay for us since our principals formed the business back over 50 years ago. So quick update on Inland. We've been in business almost 55 years. Midwest based firm, but we have a national presence. We've scaled the business through various forms of capital formation, have purchased north of 50 billion in real estate nationwide. And we currently have about 13 billion in assets under management across numerous sectors. So I think the big takeaway is we've got a fair amount of experience. We've navigated our way through numerous market cycles. We have a current asset base that is fairly diversified, which I think has really helped paint the picture of kind of the broad spanning nature of our perspective. We do have we have a good sight line into kind of front row seat onto how certain asset classes and investment strategies are performing, have performed, maybe speculating on how they will continue to perform. And that's perspective that is golden when you're developing a long-term investment thesis for whichever investment program you plan on bringing to market next. So that's kind of a big part of what we anchor our assessment on is firsthand experience. Obviously, students of the market, we read a lot, we study the macroeconomic trends, research, but school of hard knocks is always one of the best ways to kind of understand what's going on in the marketplace. And we certainly have good perspective in that regard.
Yeah, and one thing I appreciate about Inland, I know a lot of family offices and other LPs feel the same way, is just your longevity in the space. You've been around many, many cycles. Every cycle there's new sponsors that come in, and some of them last, some of them don't. To our listeners, you can refer back to episode 82. We talk about how Inland was instrumental in the creation of the DST, Delaware Statutory Trust. So I know Inland has been around a long time. Sort of to your point, you've had a front row seat, to the alternative space, and thinking about just the longevity of your firm and how alternatives have changed over that time frame. It's like that's almost like the whole history of alts, as a history, in the United States, kind of as a modern financial industry. But today we want to talk about this shift, right? And it's not a revolution, right? But there is a shift in terms of, what are some of these property sectors that family offices that investors are looking at, because one of the core, probably the core appeal of alternatives is as a portfolio diversifier, right? In times of economic turbulence and a market drawdown, you have that diversifier in your portfolio that limits the overall drawdown, something that's solid, that helps you sleep at night. A lot of family offices, they like real estate, they understand it. It's solid. We own a building in New York. That's something you can really kind of wrap your mind around. But not every sector performs the same, right? Is equally as resilient in a downturn. But why don't we start with historically, what does Inland consider to be like the core property sectors, historically speaking, in alternatives?
Sure. Yeah. And to your point, I mean, over time, all markets evolve, right? And you evolve and kind of adjust and adapt and change with the times. And Inland's had to do that numerous times throughout its almost 6 decades in the marketplace. core strategies, it's interesting. The bright lines around what was core and what was everything else, that was established a lifetime ago. And I think the market general sentiment is core strategies are four key areas. You've got multifamily, industrial, retail, and office. And so asset allocators, the mindset that you described where real estate's a good third asset class to diversify into alongside stocks and bonds. Primarily that was occurring throughout the core segment of the market. And then some of these non-core or non-traditional sectors were sprinkled in around the fringes to maybe provide some downside protection or provide some acceleration in total return. But they were always considered a little bit that, again, non-traditional, or maybe a little bit of the stigma attached to them as an alternative. And as we've had now in recent history, 2 black swan events to sort of jar our thinking and look at and modify our perspective, it's impossible not to evaluate how each sector has performed throughout some of those major periods of dislocation, as well as how they performed during some of the market run-ups that we quickly saw occur post-financial crisis and then again post-pandemic. And what was interesting is, I think intuitively you'd assume your core strategies, your kind of vanilla strategies would be a little bit more durable and would have stronger performance. And it's been quite the opposite. We've seen some of these non-traditional sectors actually, their resilience has been on full display coming out of the financial crisis and then again COVID. And so it's kind of an interesting situation where you have downside protection, but also really strong risk-adjusted returns post whatever market dislocation period you're navigating your way through. And so when you look at historical performance, now we've got a lot of data to do this. I'm talking 10, 15-year historical performance in the core areas versus some of these non-core or alternative categories. That it's a compelling narrative that I think the marketplace is really starting to appreciate and look at a little bit more closely.
Well, Keith, you talked about, I think it was the big 4, core sectors. Is office still core? I mean, I know if I go get a textbook, it's probably going to list it as core, but, on the street, or when you're speaking with families, when you're speaking with LPs or just anyone in the industry, is office just sort of out of fashion, but still core? Or is there a sense that, maybe something has actually shifted and this is not really core anymore?
I think there's probably debating perspectives around that, but I tend to favor the notion that the market's probably sort of evolving away from the definition. And like all markets, things occur that dislocate, disrupt, and potentially modify how we think about things longer term. Now, I think there's a case to be made that the return to office sort of agenda is going to propel the return of office valuations. But I do think there's a lot to unpack in that regard. Retail is another one of the big 4, and retail's seen its fair share of disruption and dislocation. So I am of the belief that the definition of core is something that I guess is a fixture in that textbook that you described, but isn't necessarily what you should anchor on being the primary driver of allocation to real estate on a go-forward basis. What's interesting, you think about family offices, some of our RIA clients, they're always looking for where they want to have exposure to, right? Exposure to certain segments of the market is a key driver of their asset allocation model. And real estate, it's kind of a well-worn path. So my guess is a lot of these firms have exposure to real estate. The challenge is they have exposure to real estate. Generally speaking, it's probably in a fund or a vehicle that's primarily a core strategy, which means they do have exposure to office and industrial. So our mindset is real estate is still really interesting, but there's been a paradigm shift and exposure to non-traditional alternative segments is definitely something that we want to shine a light on as a potential possibility to be evaluated here near term.
Yeah, and I find your thesis so interesting. You were telling me a little bit about it before we were even recording the episode, and I made the comment like, "Wow, I wish we'd recorded that and included it." But we're going to talk about it now. But real estate, again, back to family offices. I think a lot of family offices like simple stuff that's easy to understand, that you can wrap your mind around, and real estate kind of fits that bill. You think of real estate as traditional, as sort of slow moving, but it's an area that technology affects quite a bit. And I think in the lockdowns of 2020, 2021, we saw how much of an impact technology had, where it's like, well, uh, if everything is you're ordering everything off Amazon and you're not really leaving your house, you're not going to go to the office, you're not going to do much retail shopping. We still need industrial. You still need a roof over your head. Amazon still needs all their distribution centers. You still need a place to sleep. So it kind of showed like that, of course, that accelerated lifestyle shift, but it still kind of showed like actually technology does change real estate needs. And there's some of these trends in society, in demographics and technology that do change the type of real estate that there is demand for. So that being said, what are some of the sectors that you all at Inland are, where the puck is going that you see being in high demand in the future?
Sure. Well, yeah, you touched on technology, which obviously was front and center during the heightened period of the pandemic. But that's one example of how society's interaction with brick and mortar real estate can evolve and can evolve quickly. In addition to just thinking about macroeconomic, where you are in a macroeconomic cycle and which sector makes sense. So there are various dimensions to any investment thesis. Ours is no different. But what we've really anchored on here on a forward-looking basis is the belief that investing in real estate where the demand is durable through any market cycle, irrespective of where you are in a market cycle, demand is durable, makes a lot of sense. So just stated the obvious, right? Like that, of course, I think makes sense in any business plan. But second step is finding which sectors have performed and sort of showcased that type of performance during times of dislocation. And what we've experienced, the three key areas are self-storage, student housing, and healthcare related assets. Now, all three are very different and have a lot of differences, but the similarity presents a theme. And that theme is the demand for renting or using those types of facilities is completely propelled by demographic trends, life events, where an individual is in their age period, their day-to-day lives. Demand for self-storage, for example, occurs whether we're in an up market or a down market because things happen in life that require people to need storage. They don't necessarily want to rent a storage unit, but they need it because of what's occurring in their life at that moment in
Are those
time.
the three Ds, Keith? Or I forget what they are. Yeah, death, divorce, something else. Yeah.
There's four Ds actually, but it's death, divorce, dislocation, and so on. And it's what you think about there is those types of things happen when the economy's flying high, and when it's experiencing periods of downside. So storage has been kind of a bell cow in the alternative arena. It's always been considered non-traditional, but it really has proven its resilience. Again, first coming out of the financial crisis, then the pandemic. Student housing is kind of interesting because it's experiencing its own disruption within the four corners of that subsector. We're seeing demand coalesce around your Power 5, your Yardi 200 universities, so there is a situation of haves and have-nots. I have people ask me sometimes, "Hey, student doesn't sound that great. There's this liberal arts small university that's seeing drops in enrollment," and that's true. I think because we're seeing demand consolidate around some of these big name universities that have lower cost of education, you look at a university, a state university, whatever your locale is, and they're probably seeing surging enrollment. Admission standards have increased. It's harder to gain admissions. There's a huge housing shortage in a lot of these markets because they didn't prepare for this type of enrollment surge, and so there's some near-term tailwinds there. But I think over time, long term, we've always seen student occupancies just hold their own, because when it's time to send your college-bound child to school, assuming you're attached to the right university system, that demand has again demonstrated resilience, and so we look at that as kind of that fitting that similar need and theme. And healthcare, I mean, I probably don't have to say much more, right? The demographic trend, the silver tsunami, the aging baby boomer population, that supports a strong thesis, not only for medical office, but also senior living facilities nationwide.
Now, Keith, as you go through these sectors, I mean, I like all of them, of course, and I think especially what you pointed out about student housing, you're aware of the trends within academia, right? In higher education, where kind of the rich get richer, the poor go poorer. What's the saying? And for technology managers, you never get fired for buying IBM. It might be like you don't get fired for investing in student housing for Big Ten schools, or something like. But these big brand name schools, it. I guess what I'm asking is, with these kind of popular alternative sectors, and I would say especially self-storage, to me, like, the secret is out, right? It's not. I know historically it's been viewed maybe a little bit more on the periphery when compared to office and multifamily, but I feel like in 2023, at least with self-storage, the secret is kind of out. Is that reflected in the pricing? Does it almost self-correct itself as a sector being attractive because kind of like everybody knows about it, or are there still opportunities in self-storage?
Yeah, I mean, definitely this has been, the market has I think had some ability to gain awareness of some of these trend lines that I'm describing for some period of time. Let's call it 2022, and the early era of 2022. Yeah, these assets were a lot of this was priced in to a lot of these assets, so cap rates were low. We've seen a little bit of a widening out in cap rates, not a ton, because I think that certain sectors that maybe have less of a long-term upside narrative to anchor on, those have seen cap rates widen out quite a bit more. I think the good news for anybody who participated in this investment thesis, pre-interest rate hike environment, is values have still continued to hold, which I think is vindication for the thesis. But when I look at things again through a more long-term lens, there's a lot going on in each of these categories, in each of these areas, that lead me to believe we're in the early innings of opportunity within these key areas. First of all, storage, for example, it's still a very highly fragmented marketplace. Your institutional ownership, which is typically managed by some of the big, listed REITs out there, it's narrowing, right? Like maybe 15% was owned when we got into business 10 plus years ago institutionally, and now maybe that's closer to 25%. But there's still a lot of fragmentation in the market, a lot of mom and pop managed facilities. And so I think institutional transaction volume, in addition to just the positives surrounding operating characteristics, should continue to propel an investment in the storage sector for many, many years to come. I'd apply similar thinking to student and some of these healthcare related assets. When you look at data, transaction volumes were very, very small numbers being listed or cited in 2009, 2010, even afterwards in 2012, 2013. You fast forward 10 years, you're seeing exponential growth in transaction volume, which again propels that thinking that there's more liquidity in the market for these types of transactions. Again, they're becoming more widely accepted by institutional investors. So it's kind of a dual pronged thinking when, again, looking at the market through a long-term lens. Operating fundamentals are solid, and that should drive performance and growth, but demand is going to be an additional growing consideration that I think will help assets over the long term, which is why we're so excited about kind of this shift that we're seeing occur at the moment.
Yeah, and I hear what you're saying about, as these sectors begin to be appealing to institutional buyers, and that's kind of a slow moving thing, right? It's not like within the span of a year, all these institutional buyers started buying self storage or whatever, or, student housing. So it's a gradual process where you start to see private sponsors or smaller players do roll ups, and then those can sometimes roll up into bigger plays. And then ultimately, they build that multi-billion-dollar portfolio or whatever that gets sold to the institutional buyer, that gets sold to the REITs. And along the way, value is created just in the sheer the virtue of the roll up, right? And the scale, and the fact that institutional buyers will always pay a premium, right? They're going to pay, you want to sell to an institutional buyer if you can. I'll put it that way, right? You want to sell to folks who consider this portfolio, wow, that'll be easy to manage. I can put $1 billion in capital to work, with this one transaction. Those are always going to be the best multiples as a seller. So I can see as those gain traction in the institutional world, which is a trend you can kind of see play out over 5, 10 or more years, that in and of itself is creating value. Could we talk a little bit about the medical, the healthcare? That's a sector I'm not as familiar with. What kind of assets are we talking about? Are these hospitals? Are these specialty medical offices? What are the assets themselves?
I mean, yeah, medical offices tend to we gravitate toward credit profile of attendance. So some sort of affiliation with a hospital system, but then specialty type operators. So you'll have an orthopedic satellite office, or ophthalmology, or the list goes on and on, right? Skin dermatology, but it's not always the case that we're buying credit tenant long-term leases. But the interesting thing about medical office is we do see an element of stickiness within each tenant profile. It's disruptive to doctor's patient base to move readily, and so you're targeting and hoping to settle into longer term, but the probability of renewal is quite a bit higher. And in our mindset, that's a contrast or a stark difference between like student or storage, right? Because you're kind of settling into credit and durable income stream, but it does present for that opportunity to have kind of that anchor buoy mindset where you have durable income with medical office, and then you get some of your upside potential inflation adjusted growth within some of the other sectors that we target. So our goal, our game plan is obviously to provide investors with access to an investment type that's consistent with our investment thesis, and that's broad access. So we want to give investors a chance to diversify and pick and choose kind of where they make their investments, particularly within our DST market.
What in terms of Inland's involvement, what size, what price range type assets are you all looking for, when you're setting up deals or offerings, DSTs and so forth? Because again, I'm thinking of medical offices, they're all over the map in terms of size and presumably price range, right? Is there kind of a sweet spot there where you're able to, identify assets that are more efficient for you to manage, but that are still small enough that they're, maybe below the radar of some of the larger institutional investors?
Yeah, no, it's a great question. I mean, I don't think from a size standpoint, we've got a national footprint, generally speaking. So I think management efficiencies are there, which would allow us to pursue a smaller transaction if the fundamentals were there and it made sense. I'd say by and large, it's a pretty wide range. We'll transact on the low end 10 million, and on the high end, 200 million. It really just depends on, we cast that wide net. We look at, we pride ourselves on having seen just about everything out there that trades. It's not 100% success rate, but our acquisition team does a good job of making it known to the market that we're interested in evaluating your opportunity. And so we gather a lot of data throughout that process. And then our goal is to sort of well-worn path, right? It's a funnel. So you look at everything, you evaluate what you want to pursue. You don't end up getting everything you pursue, but that qualitative funnel has served us well over the years.
Absolutely. And, like I said, you all have a very big name, high quality reputation in the space. I'm sure that doesn't hurt. If I own a property and I, get an email or a letter from Inland, like I'm certainly going to respond. Right. And on that note, I wanted to just check in on the DST space. DSTs, they're a product, they're an industry we've covered on the show. I know we have a lot of listenership and viewership who are big fans of the 1031 exchange, and as well as DSTs. The DST market a couple of years ago was obviously white hot, and you had products opening and closing in a matter of weeks. And I know it's slowed down a little, but I guess, Keith, I'm just asking for a pulse, a market pulse of the DST market in 2023 here.
Yeah, I think I'm pleased with its trajectory. I think context is important here. The market is clearly off its to use your term white hot levels in 21 and 22, but it's consistently chipping along, and I think last data set I looked at, we're on pace for a $5 billion, maybe $6 billion year. Which is remarkable. It's way off 22, but it's remarkable if you compare that to, pre-pandemic records. And I think that's important. The DST market was new in the early 2000s, and anytime there was option, I think of an industry, but now with north of 2 decades under its belt, the DST market's here to stay, and it's going to have ebb and flow. It's obviously demand is driven by a transaction occurring, right? You can't have a 1031 investor without them finding a buyer to buy their property to begin with. So that's cooled things a bit, but by and large, I think the industry's on pace for a solid year, all things considered, and we are actually seeing on a month-over-month basis an upward trend line. So August is quite a bit stronger than January was, to kind of underscore it. And I think most assume Q4 will be the best quarter the industry has seen throughout the 2023 era. So we're collectively gearing up, and I think the future continues to be very, very solid for the DST industry.
Well, I think some of the numbers that you quoted speak to the enduring popularity of the DST product, right? Because if we're maybe not smashing the records of 2 years ago, but compared to 5, 6, 7 years ago here in 2023, with interest rates where they are, it's like, well, this is still very, very popular. There are still plenty of transactions happening. That bodes very well indeed. Presuming that interest rates don't just climb indefinitely, which we know they won't, right? Because things happen in cycles. Any predictions, I guess, in the DST market besides growth? Do you see any other changes or trends in the next 5-10 years that investors might keep an eye out for?
We're definitely starting to see more institutional uptake in distribution of the product, which I think has largely propelled the industry's just hockey stick growth here in the past 5+ years. And one of the product structures that I think is gaining steam, particularly with your upstream distribution partners, Wirehouse channel, some of the RAA channel, is the UPREIT, the 721 UPREIT concept, which there is some interplay. I'm not going to dive into the weeds too much. You could probably do a whole podcast on this, but
we did, Keith. I have to. I'm sorry, Keith, to plug the show. We did do a whole podcast about 721 UPREITs. So, but carry on.
You did it. No, that's great. But there is, I don't think that ever replaces the pure play DST, because I think there's a subset of investors that want to be real estate investors in direct real estate, want to know exactly what they own, and that's just how they want to leave it. But as this gaining demand occurs for 721 product, I think you're gonna start to see maybe more of it within the marketplace, maybe a more balanced effect, and that's good. I think that's good growth. I think that's an industry and a market reacting to investor sentiment, the sentiment coming from the investment community. And I think that's what good, healthy industries do. Is they again, you don't rest on your laurels of the past. You evolve and you grow, and that's how you stay relevant for decades as opposed to a handful of years, right?
100%. Keith, it's interesting. You mentioned the UPREIT. Obviously, we're talking about DSTs and 1031s. It still amazes me how many family offices, high net worth investors do transactions that are not structured as 1031 exchanges. Is it just me, or I just find it amazing, really, any transaction occurring with investment real estate, private owners? How do we get the word out? How do we find these I don't want to call them stragglers, but, these last few folks who haven't yet discovered the magic of the 1031 exchange?
Yeah, it's well, I think that is just conversations like this maybe help in that regard, and we just clearly have to get that messaging out. I mean, we're talking about a provision that's been in the code for over 100 years,
Yeah.
and it's a powerful tax planning, wealth building tool that I think many real estate investors have used over the years, and it's it helps to drive and propel the liquidity within the marketplace, right? I think real estate would a lot of property owners would probably just squat on their real estate longer if they didn't have a tool to that allowed them to reinvest into another piece of property. But the fact that it exists, to the extent you're transacting, it's something you have to familiarize yourself with. You have to at least incorporate into your strategy if you're considering selling investment property.
And it's not going away, right, Keith? I mean, every couple of years, there's some headline in the news, politician, so and so, whoever, talking about either doing away with it or really curtailing it to the point where it would be an overhaul. I'm always skeptical. I always think it's much ado about nothing. Do you think there's any serious risk in the next decade or two that the 1031 exchange would be seriously curtailed?
I think the minute you have guys like me saying there's no risk is when we probably have something to worry about. I think there's a healthy paranoia, and I'm sure it's going to come up again and again through election cycles, and there are certain when doing kind of a tax scoring analysis, there are pundits that look at 1031 as a potential pay for some other political agenda, and usually that's due to lack of understanding with how real estate buying and selling actually works. That's why I made it a point to say it does propel liquidity. There's a lot of investors that just wouldn't sell if they wouldn't sell as frequently if they didn't have a tax deferred exchange opportunity on the other side. And so that's the messaging I think through various industry associations, we continue to make sure that messaging is delivered loud and clear, and there's nothing that kind of gets lost in translation. But it's something that I'm sure we'll continue to have to work through as the ebbs and flows of politics occur, from here to 10 years and beyond. So just keep going. But no, I don't think there's any imminent threat at the moment, which is good news for listeners.
Yeah, and I think we're probably preaching to the choir about the benefits of the 1031 here. And to your point, not only the liquidity, but all of the secondary industry effects that has, all of the jobs that exist are created, are sustained because the 1031 exchange exists. I mean, think about this year, 2023, all things considered, not a bad year, really, right? For DSTs and a lot of, not every area of the market, but all things considered, not a bad year. Now imagine there was no 1031 exchange provision, it'd look a lot worse. And a lot of the folks, not just in the alternative investment space, but just in the real estate space, we'd be a lot worse off, in my opinion. Yeah. Again, I know I'm preaching the choir, though. Keith, we're about out of time here. Where can our audience of high net worth investors and family offices go to learn more about Inland?
I think our website is pretty dynamic. Just www.inlandprivatecapital.com. There's obviously a contact us section there, so we'd love to hear from you. We've got a whole investor relations team and customer service, so they'd be able to get you connected with whomever you'd like. So that's where I'd send listeners.
Absolutely. And I'll be sure to link to that on our show notes, which are always available on wealthchannel.com. Keith, thanks again for joining the show and sharing your insights with me today.
Absolutely. Thanks for having me.